So we had a really down week, and I'd like to review the stock market. Overall, we had several down days and a significant one today. And I thought it'd be a good idea to just catch up with the community and see what you guys think on the stock market. There were a few earnings reports today that I could cover with Exxon and Chevron, but I wanted to kind of cover the Nasdaq, which has entered correction territory. It's down more than 10%. Also go over the VIX, which is interesting to take a look at. Looks like JS Yao, thanks for joining. I think it's your first time on the live stream. I really appreciate you joining. Looks like you're from Toronto, Canada. Thanks for joining. The best of, thank you, sir, for joining. Please bring up topics you want to talk about. It's a little bit of a free schedule on this live stream. I just think it's a significant week. It's probably the most significant week I've seen in the year of 2024. It's interesting that when you look at first, the Nasdaq's in correction territory. If you measure the high in 24 to this point, we're down 10.04%. And I would say that the correction's not done. I think the momentum is for stocks to sell off. The fear is in the street, and there'll be quick sell-offs for stocks, and it's just going to be a little ugly, a little messy, a little painful for us guys who own some stocks to get hit. But overall, it's going to be a big opportunity. I've lived through crashes, corrections. I've invested through crashes and corrections. And some of the best investments and the most money I've made is making money when everybody was afraid. So I can share a few stories there just to keep our heads in the game, which is now it's time to really look at companies. Now it's time to really start making our investments in companies when nobody wants to do it or begin to not want to do it. And as we see those prices come down, let's snatch up those companies that we really want or more shares in companies we already own. So looking at the NASDAQ, here's what's interesting. I'm going to look at the S&P, and I'm not a big technical guy, but I like graphing and charting. In my university days and frankly in professional life, I'm really good with statistics. I aced all my classes. So I get charting and I get what it's all about. But I think you can pick up on certain trends. If you look at graphs, they'll tell you what's going on. So if I look at last year, when did the decline begin, right? And I think I need to go back a little further. In 2023, we had a correction, and the correction started July 28th, and it ended on around October 27th. This is a year ago, almost to a day, right? It was just 2 or 3 days late. Here we are correcting in the late July, early August timeframe, which is interesting. Now, just a year ago, the lesson was, okay, some stocks were really sold off, especially financials. I made good money in financial stocks, and then they rallied hard for the remainder of the year. I don't know if it's going to rally really hard to finish off the year. I don't know that data repeats itself just perfectly, but it rallied hard. It was really, really good returns for investors. So just wanted to point that out that, hey, the market I felt was expensive. I kept commenting that on live streams and on videos that, hey, I think the market's expensive, and some sectors more than in industries more than others. Now, when I look at the VIX, there's one thing that, the VIX is a measure of fear. And although it's a little bit of a rear view mirror measure, which is it's measuring everything that's been going on very recently, what I want to point out is it has hit a measure that is well above last year. I just showed you that last year we had a 10% correction in the S&P. The S&P is only down, I think, about 7-8% to this point. So the reason that I think that we're going to go into a deeper correction is the fear is pretty intense. And I think especially for some industries, and I'll call them out because it's not the first time you've heard it. Semiconductors well overpriced. If you look at Nvidia, Broadcom, TSM, those stocks are beginning to correct. Some industries that are really tied to the AI build out, I believe AI is interesting and it may be something really big in 5 to 10 years. But between now and then, what are companies going to report? Hey, we're going to be great in 5 years. That's not enough. You got to show what you did in that quarter. So having said that, I think you're going to see a lot of corrections in stocks that were overheated and overbought with this theme of data center build outs and the AI hype, as well as, some other sectors. I think travel is another example. It's been doing really well, but I think it's getting pretty late in that particular trend. And I think it's going to begin to fade, especially as we see now the potential of a recession coming. When recessions hit, people travel less. People are like, instead of going and traveling and spending, $300, $400, $500 a night to stay somewhere and buy, airline tickets for my family, I think I'm just going to stay home and wait this thing out until we see that the economy is better. So we'll see how that happens. So generally, I think that's where I'm seeing that the market's at. It really does provide an opportunity in a lot of ways. Let me catch up on comments, and then I wanted to make a couple more points here. So Best of wants to talk about Intel. I will talk about Intel. It is going to be a painful exercise because I'm an Intel stockholder, not a big position, but it hurts to own a stock and see it go down 26%. What the heck happened? So I will try to be objective and provide a good point of view on Intel. We'll cover that. How's the housing market in the US? So, the housing market, and I've been an investor in real estate, for a while. I started investing really in real estate that I rent to other people in 2010. And I bought 6 investment properties. So based on my experience there, I bought 6 properties. I sold 2, and I did really well with buying at the right time. That was another time when the market really oversold real estate. I bought at a really low point, and I made, significant gains on real estate that I bought during that era. Real estate got very, very expensive around 2021. It just became incredibly expensive. And I live in Southern California. My whole life, I've heard real estate's expensive. And guess what? People buy houses here to live in, and investors buy them and they rent them out to people. But it just became so risky. And this is why you buy a property. If it goes down in value, you pretty much lost your whole stake because you usually put down 25% on investment property. And if it goes down 20%, you lost pretty much your whole investment if you include the transaction cost. So in general, my observation is that the real estate market is going to begin to see some bad days ahead, meaning prices of real estate should begin to go down, which is kind of good. We need some relief there. It's not investable. I don't want to buy real estate right now, not in California. And really, I just don't see a lot of opportunity in residential real estate. I just think it's too expensive. I look at alternative investments. I can make far better returns in alternative investments for less risk. So my answer to you is the market here, we're beginning to see more inventory of homes for sale, which is a good thing. That way people have more to choose from. And I think that more inventory will drive competition. So sellers will have to reduce their prices so that the one buyer that's looking at maybe 3, 4, 5 different properties, they get that sale done. So the state of real estate, I think, is potentially, rotating from it being a seller's market to a buyer's market. Real estate's super slow, and we'll see how fast it makes that pivot. And we'll see if it makes a complete pivot. Real estate's really surprised me a few times over the last 10 years, but a few times I've nailed it, especially buying real estate in 2010. I went big, and it really ended up being a windfall, which I'm glad I did. All right, so let's talk about Mike, the dividend investor guy. Thanks for joining. Good to see you again. And I don't think I shared. Well, Do you think it will affect REITs negatively? You know, I guess, it depends on the REITs, right? Like some REITs are being impacted just by other trends, like commercial real estate REITs that own office buildings. They really took a hit over the last really few years when we saw that big shift of people working in the office to working at home. So that one's kind of been played out. In fact, that might be an opportunity where those REIT prices are so low, you may buy a shares in a REIT and see that the price of those shares go up. I own a REIT with CTRE, and it's done really well, but that's a healthcare related REIT where they own properties that elderly people go live that need a little bit of healthcare nurses to tend to them and take care of them. So I think REITs, that is one thing that REITs do insulate you from the jagged moves of real estate potentially. Like you don't get caught into, like, if you bought a property, it's really hard to get out of it, but REITs, it's very easy to get in and get out. So that might be a good idea. Lower interest rates it's going to be very good for REITs. Low interest rates mean REITs can build more properties, they can buy more properties, they can operate more properties with a lower interest rate. So I actually think the conditions that I see going forward are positive for REITs. And I bought into 20 stocks today. I love the discounts. You and I would get along just fine because I don't know if I bought 20 stocks, but I could tell you I bought a long list of stocks. And I bought into Amazon early in the day because Amazon, there's only one Amazon. I owned Amazon for a while. I sold it at the end of 2023. Now, I made a good gain, a really good gain. So I felt good about that, and I cashed it in. But God, it felt terrible to see the company continue to rise. Well, it came down. It's come down quite a bit. And in the day, I'm not a day trader, but my investment went up 3.5% in one day. So that was good to see. I too saw an opportunity to buy further into stocks that I already own. I bought into Amazon. I'm going to build that Amazon position. I'm probably not going to ever sell it unless Amazon changes for the worse. There's only one Amazon. And I really, it's good to exercise, my exit strategy on a stock and my plans. But because once I do, I realize, the next time I sell one of these really good companies, I'm going to think a little longer and a little harder and make sure that I keep those really, really good companies like Amazon, Google, Meta, Airbnb, Uber. Those companies, it's going to take a lot for me to sell them. Shadow Guy. Hey, Vic, just going to say both you and I have lived through a lot worse. Absolutely. Let's take a look at a chart really quick. So go into the history books and say, all right, this was a bad week, but let's talk about, for example, this was a doozy of a period. Was this the period? Yeah. This is the Great Recession. This is where the movie The Big Short, where they shorted the mortgage, the mortgage industry. This is where banks were going bankrupt, and big insurance companies like AIG were about to go bankrupt, and the whole economy was going to freeze. And we saw stocks drop like 25-35% in a very short period of time. Now, during that time, in particular industries, it was horrible. Like if you were in mortgage lending and you worked for Countrywide, it was horrible because a lot of those employees lost their jobs. If you worked at AIG, it was really tough. Or what was that? I think it was Lehman Brothers. They completely went out of business. They no longer exist. And there was another firm, I forgot their name, but so it was very painful for that industry. Outside of that, I continued to think, all right, so is it going to affect Google? Well, not really. Google isn't in the subprime mortgage, subprime mortgage industry and so forth. So I did not sell one stock. I did not get out of the market. I actually put more money into the market during this period. and it ended up coming back. And COVID, right? In a short period of time, COVID, you had a crash of 32% in 1 month. So that was horrible. That was weird. The whole we're all going to sit at home with a mask on, experience was really something. I didn't sell one stock. I didn't sell one share out of fear. What I did start doing was, okay, what's going to work going forward? Because the recovery of stocks was tremendous. If you look at from the trough, from the very bottom of that market to the very top toward the end of 2021, 107% return on the S&P. So, this is an opportunity when you see stocks, drop like this. Okay, everybody who kind of runs for the exits, they're selling out, and hopefully they want to come back in, but they end up coming in like up here, and then they pay a higher price for a stock they just owned. They owned it at this price. They sold it at this price. So that's why I don't sell out of fear. In fact, I'm like, hey, if other people are fearful, I will gladly buy their shares. I'll buy them at a discount, and I'll hold them in companies that I believe will rise over time, because the stock market over time rises. It may take a while, but it will rise. So absolutely, I'm right there with you, Shadow Guy. Same, I started dollar cost averaging. Yeah, Amazon, I think, came down, and I did their earnings on the live stream yesterday. The reason I thought, stocks are overpriced is kind of playing out, because Amazon's earnings were good. They grew. They're massive. They're really profitable. They have their hyperscaler business, AWS. It's the biggest one. It's strategic. All these businesses depend on that business to, build out their AI, whoever's doing it, to run their operations. They are so mission critical to other companies, and they make a lot of money out of that business. And I can go on and on. I mean, I could spend the next hour to 2 hours talking about how great Amazon is. So to try to get into an Amazon and wait for the market to sell it off and then jump into it, that was a really good moment. And that's part of today. Among all this forest fire of problems and kind of bad news, there's some good news in the market. Mike, the dividend investor guy, most of the REITs were up, and I was wondering if people thought those would be hit too. Now, I just talked about how interest rates are actually lower interest rates. That's really good news for REITs. It just gets, because they carry a lot of debt, as you would understand. They own these properties that are really valuable, and then they take out debt. Well, they can reissue that debt in lower rates, or the next deal they do, let's say they buy another property that is in their particular specialty. It's just more lower interest expense, more profitable for them. So that's how I think it's going to affect REITs. I think REITs now look better. Might be a good place to look. So which industries do I think are going to perform well in the second half? So healthcare, REITs. I think, I hate to say it, because like consumer staples should do okay. And the reason I have like a disclaimer on consumer staples is consumer staples over the long period of time is going to underperform other sectors. So yeah, you maybe do well in consumer staples for 6 months, maybe 12, but you got to have like a plan to, either stay in the other sectors that are going to outperform consumer staples over the next 5 years. But I think healthcare is going to see good months ahead. Staples are going to be in good shape. Real estate is looking pretty interesting. Mortgage lending is going to look really good. So if you look at financial services, those companies that are doing mortgage lending, they're going to start producing earnings that are going to just blow away expectations, because you think of everyone who wants to refinance. Hey, I'm sitting on a loan at 7%. Boom, you get it down to 4.5%. You're loving life. Those loans are going to happen quite a bit. It's not necessarily going to be dependent on real estate transactions happening, But as you see these declining interest rates, you're going to see mortgage lending really happen. You're going to see, so I know small caps took it in the teeth today. Look at that. The Russell went down 3.5%, but I believe small caps are going to set to perform in the second half. Lower interest rates are going to help them. And I think if you see the mega caps get hit, where are you going to take your money? You can take it to cash and make 4 to 5%. You can take it into bonds, but I think small caps are probably going to do fairly well. I know I'm going to look for a couple more small caps and put a little more money into small caps. So thanks for the question. I appreciate it. All right. Mike, the dividend investor guy, never say never on selling, because if B doesn't do better, I may drop it. I hear you. I bought after the close my puts on QQQ. Okay, cool. So you closed your puts on QQQ and you bought Amazon. Nice. Looks like we think alike. All right. Hey, David, thanks for joining. All right, cool. So we got two things to look at. We got Intel to look at. I don't think there's any more comments. Let's jump into Intel. So Intel is, man, how can the story get any worse for Intel? This is, so I live in California, and if you go up to San Jose, California, and you go, San Jose was like a tiny town like 30 years ago. And the Silicon Valley basically is just north of San Jose. I believe it's included in the Silicon Valley. Google built a giant campus there, and Intel is just in Santa Clara, just north of there. And there's a museum where it's the Silicon Valley Museum. I don't know if they call it Hall of Fame or museum. And they go over how semiconductors are a huge industry now. And, they kind of, that was the hotbed for semiconductor, led by Intel. And Intel was so instrumental early days of the semiconductor industry. Fast forward, they were a giant company, but for the last 5 years, man, so many bad decisions, and they just didn't see the AI thing coming. They didn't see how important the data center was to semiconductors, and they're really missing out. They stuck to the PC, which is, one thing, but I think Intel really took their eye off the ball, and their competitors, NVIDIA, I applaud them. They're awesome. It's great. They're just the price is too expensive for their stock, but the company's incredible. They really thought well about, what was coming and what was important. Accelerated computing would become more important. And I would say that they both were smart and lucky. So NVIDIA now is the most valuable semiconductor on the market. TSM built, the foundry that the many companies depend on. So all those things happened in front of Intel. So strategically, Intel, you guys made a lot of bad decisions. Today was horrible. Let's take a look at the 1 year chart. In 1 year, these guys are down 37%. I'm surprised that they're down 37%. I would have guessed 60 to 80%. Year to date, they're down 56%. It was a brutal drop. When you look at their earnings, now, I didn't think the earnings were that bad, but I would say that the way that Intel approached their earnings, it was like amateurs. If you're going to surprise the market like you surprised them today, then a month ago, like early July, you voluntarily communicate to the market and say, we're going to disappoint you when we do our earnings. We're seeing some headwinds. We're having some problems. There's going to be some things that are going to keep us from being able to deliver. But once you get to the earnings and then you drop all this negative stuff on one earnings report, this is what happens. So you see companies that are like, hey, we're going to guide into our earnings a month in advance because things are way worse than we thought, or way better. Hey, we're going to guide up because you know what? I get that it'd be cool to have an earnings and then our stock pops 25%, but I think it's better. It's more, I think we'd have better trust with our investors if we told them something when we knew it. Now, if they didn't know a month ago that their business was so bad, that's even worse. So if they knew their business was struggling a month ago and they knew, man, we're going to go off a cliff on August 1st, then on July 1st, you put it out there. You say, guys, you know what? We're trying really hard, but it's not working and we're falling behind and we're losing money. And, the layoffs, I understand you may have to wait till a certain point, but they dropped a lot of bad news all at once. And that's what happened. So I'm really disappointed with the company. I think the business is a good business, but um, it's not even a top 5 semiconductor company anymore. I still have them in the top 10, but boy, they might come off that list soon. Their revenue wasn't too bad. Year over year, a drop of 1%. That isn't too bad. Okay, not a big problem. They did lose money, and that's because they are taking an expense for all the they're going to do layoffs. So they're going to have severance packages. So they have to expense that. So I get that expense. They're going to have to pay it. Okay. So they lost money in the quarter for that reason. And I did look at their income statement in the live stream yesterday, and we revealed that, okay, that's where the loss in the quarter came from. They're going to reduce 15% of their headcount. A semiconductor company is only as good as their ideas. And if they're not going to have great ideas, the company's going to be limited. If you're a brilliant person graduating college and you're like, okay, I have my choice of working at Intel, NVIDIA, or Google, Intel's immediately eliminated from that, candidates list. It's like, hey, I'd rather work at Google or NVIDIA. That's an easy conclusion. So that is really strategically a really bad thing for the company that I think they're going to have a hard time getting talent, and they are going to lose quite a bit of talent, in this reduction in force. So overall, from a financials perspective, it wasn't that bad, but the loss was troubling. The other piece to it is they are trying to build more foundries onshore in the US. That was one of the reasons why I bought into the Intel stock, is building these foundries could be a strategic advantage for Intel, because right now most of the chips are manufactured in Taiwan. Well, if the president in the White House after November, I guess they start their new term in January, is against China and creates, and I think the comments that the Republican candidate said was he's not going to protect Taiwan for free anymore. He wants them to pay for protection, that if they don't pay, that he's just going to be like, hey, you got to defend yourself. If he did that, China will take it over. So if there's geopolitical tension of that type, like China takes over Taiwan, holy smokes. How do you feel about TSM, NVIDIA, Broadcom? Those companies depend on the manufacturing in Taiwan. So to have that kind of risk, I think is pretty significant. Intel building foundries in the US takes away that geopolitical risk out of those companies that want to design chips and have Intel manufacture them in their foundries. So I thought that was a really good idea. So I thought it was a good path forward. But boy, they better start getting some wins because their business is pretty much torched right now. And I've said this before about Intel a couple of times over the last 5 years. It can't get any worse than this. Well, I've already said that like 2 or 3 times, so I guess it could get worse. So Intel, right now, I think I'm going to give it a week, let kind of like things settle. I'm pretty disappointed with them, so I want the disappointing kind of emotion to kind of dissipate, and then be clear-headed. What do I want to do with that position that I have? Let me take a look at how much money do I have invested in Intel. So I invested $18,242, and that's worth $11,400 today. So it's not a giant position, but it's still, man, it really ticks me off that the company could not have communicated to shareholders a little better. So I'm going to let things kind of cool off, and then I'll make a decision. I may exit the position just because I just don't want this thing in my portfolio. You know what? There's plenty of other investments that I can make money on, and I just don't want to be bitten again by Intel. So thanks for asking about Intel. I appreciate it. Okay, so let's talk about 2.5% inflation. Really, it's 7.6 inflation. I'm not quite sure I understand that, but maybe you can add more comments. It's a two, I mean, inflation, the way they measure it, it's a barometer, right? Yeah, you can have certain like categories of commodities, they're 10% inflation, and some you see a decrease in prices. Like I believe insurance rates went up significantly in 2024, like a lot, like 25%. And in some cases, some categories, the prices actually collapse down. So, oh, that product is 40% less. But that's a barometer. And I do believe in the economic data that the government puts out there. Sometimes it's useful. Sometimes it's not very clear and useful, but I believe in it. All right. So the San Jose Tech Museum, now called Tech Interactive, apparently. Yeah. Yeah. It's a pretty cool museum, teaches you, stuff about technology. And I thought it was interesting. Mr. 123 Cheetah, a friend works at Intel and told me a few months ago that it works like a government institution now. No work culture. Yeah, that's too bad. I mean, if you're in the Silicon Valley, you got to have a culture of innovation. Ideas win. You know, you look at the best company, or excuse me, the most valuable company. Apple's up in the Silicon Valley. They thought, hey, we'll redesign the smartphone, and they certainly did, and they got this massive business. And the number two player, Microsoft, well, their ideas got really good software, really good cloud. If you don't have good ideas, you don't belong in the semiconductor industry. You have to have really good engineers, really good people that are going to be developing the next generation of your technology. Hello from Greece. Very nice to have you. Thanks for joining. And I think the sell-off has been global. If we look at I don't know, like Asia, huge. The Nikkei sold off big. It sold off 5.8%. And then I think this is Hong Kong 2%. And I'm not sure what these are. In Europe, the DAX sold off 2.3. FTSE, I believe this one's in UK, 1.3. This one's in France, 1.6. And I'm not sure about the other two. And DAX is in Germany. So this thing's kind of circling the world is, hey, stocks are expensive. They're going to sell off. That's kind of like the story. The S&P, if we look at the high point to now, it's down 5.6%. 5.66%. So the S&P has the bigger companies in there, like Apple and Nvidia, Alphabet. So I think those are keeping that index, or that the S&P, I guess the index, that propping it up, as opposed to the NASDAQ is really showing probably a more clear sign that, hey, that a lot of stocks are selling off. No problem. Dylan, thanks for joining. And I really appreciate you joining. I know that your work schedule is tough. We all got to work. But I appreciate you joining. All right. So we went over the economy. One thing I wanted to show is bonds. So, bonds have a way, or traditionally, this week's an example of how stocks could really sell off and create big losses in a portfolio. And they certainly can. And bonds are a way to counter that risk or manage risk. Because when you see, like here, I'm going to point to the 5 year. This means that the interest rate paid on a 5 year bond issued out by the US government has gone down 0.221. And that, I think they would call it, is 221 basis points of interest. It went down. It has almost an opposite effect to the price of that bond. The bond to the price goes up. So I own bonds. I have a 5 year bond ladder, and then I have some longer term bonds, but not a lot of them on the longer term category. So bonds will rise. I don't know if it's going to be 0.5% or maybe a little bit more. That's a really big move in bonds. Now, as I get older, having investments like bonds are important because, I love trading stocks. But could you imagine if we had a super bad correction? Let's say we just started that. And I'm like, holy smokes, man, my portfolio just got hit with a 25% reduction in my stocks. Well, I'll be really glad that I've got a bond portfolio, because that my bond portfolio has been rallying during all this pain and suffering in the stock market. Bonds go up in value, and it's been interesting. So my bond portfolio, I'm really glad that I put the time and energy into it. It is boring. Bonds are boring, but it's almost like insurance. You buy it so when you need it, you got it. And then, oh man, I'm glad I got the insurance because my car was parked on the street. A tree fell on it. It's totaled, but the insurance is going to give me a check and I'm going to go get another car. I'm really glad I bought insurance. Well, I'm sure that when you first bought the insurance, it's kind of like, damn, why do I have to pay this money to pay insurance? It sucks. Well, bonds are kind of similar. It's like, okay, I'm putting, a chunk of my portfolio in bonds. They're not all that exciting, especially when my stocks are just, kicking ass. But the bonds are meant to be, hey, they're just going to be stable. They're going to pay an interest rate. It's going to be a more dependable investment that has lower average returns over time. But in times like these, they stand up pretty damn tall because everything else is collapsing around them. So that is interesting to show. I'll do a video on bonds just to kind of go over bonds and bond ladders and stuff, because this is the right time to talk about it. It's like, hey, how do you prepare for these, corrections and stock crashes? Is you want to have some money where that money is going to keep you going for the next 5 years. My mentality, this is my mentality, is I have money in bonds and in cash, and I can take care of my family for 5 years. The world can collapse around me. Hey guys, we're good for 5 years, and I'll have to figure out what happens, after 5 years. But I think looking at markets, they have maybe a bad year, maybe 2 bad years, and then we start picking up again. So that's my mentality, is put money in places so that it covers a period of time when stocks are just brutally bad. So when they rise again, you just start participating in the rise of stocks. So that's my mentality. Get 5 years, make sure 5 years is taken care of, and then we're good. So, all right. So good question there. I'll take a look at doing a video on bonds, and my bond videos don't get a lot of views, but maybe they'll start getting more views now that people are getting crushed on their stocks. Cool. Thanks, Dylan. Thanks for saying that. I appreciate that very much. I hope you get a lot of value from being a part of the community. Let me remind everybody, we have a Discord going. Look at the community page, and maybe I can just grab the link and put it on the live stream. It'd be great to have everybody join the Discord. We've had really good collaboration on the Discord, and it'd be great to have everybody on this live stream join it. If somebody on the live stream can grab like one of the invitation links and pop it on the chat, I'd really appreciate that. Sometimes I can't do two things at one time. So thanks for joining. What time period bonds do you prefer? I guess it depends on how much cash you have. So here's the thing. Bonds, everything's situational. Here's my bond ladder, right? Now, 2 years ago, if you were in short-term bonds, you were a genius because short-term bonds were really paying really well. Long-term bonds, if you remember Silicon Valley Bank, they had these really long-term bonds. And as interest rates flew up, right now interest rates are going down, which causes bond values to go up. Okay. The opposite happens when interest rates start going up, bond values drop. So Silicon Valley Bank was left with, oh no, we have to restate our assets and say, we're going to take a big loss on our bond position because we have 10, 20-year bonds, and they have to rewrite them or write down that position. So 2 years ago, people were buying short-term bonds, and anybody who's staying there a little too long, they're going to start to suffer. What I decided was, investing is both situational and a couple other factors is, hey, build your portfolio around you, around what you want, the money you need in 2 years, 5 years, 10 years, the things you want to do for yourself, for your loved ones, right? Build your portfolio to have that type of result and those outcomes. So for me, that whole 5 year, if I can take care of my family under the worst of conditions for 5 years, I should be fine. I've figured out life. I know what the heck to do to make money. Yeah, I might have a bad year in the stock market, a bad year, but I've never had consecutive bad years. Have I made a bad investment in real estate? Not yet, but I'm sure I will someday. And I might lose, I don't know, a couple $100,000. Well, when that happens, again, I want the next 5 years to be taken care of under the worst conditions. I could have a bad real estate deal. I could have one of my big stocks just go really bad, like Intel, and oh man, I lost some money. So I started really saying, okay, I've got bonds covered for 2025, and they're going to redeem, at a value of $102,000, and they're going to pay me interest, during that time, equivalent to 6.2%. And that doesn't include the appreciation that I've seen on these bonds, because they appreciate if they go up in value. Collectively, the return on these bonds is going to be closer to 8 or 9%. That's a pretty good return on bonds. So that's year one. And then year two, I've got 2026 covered. I've got bonds that will redeem at a value of $88,000. Okay. So I don't have to touch these. Bonds are super boring. It's like, okay, let's take a look at an example. Vici is a REIT, and they have this bond. It's going to redeem in 2026. I know Vici. I think it's a good company, and voila, set it and forget it. I know it's going to pay me a certain coupon rate of 4.5%, but I bought it at $1,800, but they're going to give me $2,000 at the end. So the real yield is higher than the 4.5 because you need to add the differential between 1,800 and the 2,000. So that's how I do bonds, and that's how I invest in them. I need to be aware of interest rates and where they're going, but I tried to have bonds, take care of something that was important to me in my portfolio. And I tried to buy during good periods. Like, I'm really glad I bought bonds that are longer term, because now as rates fall, it's going to be harder. Let's look at the 5 year, like these. It's going to be very hard to go find JP Morgan and have it pay me, 4 or 5%. They're probably going to say, no, interest rates are lower. If I sell you that bond today, I'll pay you 3%, which is less interest for me to earn. So bonds are not going to be as fun and exciting as stocks, but they're also not going to keep you up at night. So hopefully that was interesting to you. No real return on bonds. Yeah, there's two ways to think about that. When you have negative years, and let's go back to 2022. At the beginning of 2022, we were all like, hey man, this rise in the stock market has been so fun. It's been phenomenal, over 100%. And then companies, every single one of the great companies, Meta, Nvidia, Google, Amazon, they all started to go down. And the whole market corrected 25%. During this period of time, yeah, bonds only do like 4, 5, 6, 7%. But on a year like that, you got to think about they didn't lose 24%. They actually gained 5%. So it's almost like they outperformed the market by 30% because you didn't lose. That's why bonds are an asset class that I like for a part of my portfolio, is that they rarely ever lose value, where stocks do lose value from time to time. And you're going to have to wait out this correction. Because really, if you were sitting on Meta stock as an example at this peak, let's use Meta as an example because that's my biggest stock. And Meta over the last 5 years, the high point was in, late 21. And let's say you had 100 grand in that company and it went down. You're like, oh my God, my 100 grand turned into 24 grand. Oh, that was painful. And you had to wait until probably January 19th of 24, roughly 2 years later, to get back to even. So that was rough. So when you say bonds, there's no real return. They're not supposed to give you a stock-like return, but they won't give you the volatility that a stock will. Like Meta is a great company, and look at the volatility they served us up over the last 5 years. So that's one thing to consider. Again, if you're young, invest in high growth stocks. Don't pay attention to bonds. Don't worry about bonds. If you're 25, 35, even 40, I don't know that bonds are all that important to you. If you're 50, 60, if you're up in my age bracket, get really good with bonds and fixed income, because if you're like me, hey, I want to make sure the next 5 years are taken care of, and bonds can certainly do that. I can't depend on stocks to be solid for the next 5 years. We're seeing evidence of that this week. So I like Discord. Cool. And it looks like, do you think we're going to have a recession? The answer is, I would say 50-50. I think that there's a 50% chance we can have a recession. And I'm certainly seeing certain factors that make me believe that. One is the job losses, like the job report today. Nothing really, what determines a recession mostly is job losses, because job losses mean like Intel. Oh, we're going to reduce 15% of our workforce. That means a lot of things. They're expecting a reduction in revenue. They just have to trim so much. So as other companies begin to say layoffs, that means that companies are not going to make as much revenue. That brings down our GDP, because recession is defined by a loss of all GDP, 2 consecutive quarters when GDP goes down. And as we see more bad news like that hit the market, you're going to begin to see it show up in earnings, where companies are going to be like, oh, our revenue went down by 5-10% or even worse. People are stopped traveling. People have been traveling like crazy. Cars aren't going to sell. All the discretionary items that, consumer discretionary has been just doing great. Well, it's not going to do great if people begin to fear that they're going to lose their jobs, or even worse, they lost their job. They're not going to buy discretionary products. They're going to be like, no, I got to save my money. I'm going to Costco. I'm going to get on my low cost lifestyle for a while until I, get a solid job and get my savings back up. So I do think we're right there, potentially going into a recession. Is it going to be caused like by one factor? Maybe something shows up. You always have these bad events, these black swan events. Maybe nothing like COVID, but we'll see. That's how I'm feeling about it. That job report really did surprise some people, and it made me open my eyes to the fact that jobs have been being lost over the last 6 reports, that they've shown, it's shown that a steady decline. It's almost like it's decelerating. So at that point, at some point, it's going to go negative. And then Dylan, do you think we'll have recession? I'd like to host a call on the Discord tomorrow for everyone. Yeah, it sounds good. I have to be honest, I'm new to Discord. I'm not quite sure what that means. But if you think it's going to be good for the community, I'm all for it. Let me know how I can assist. And if you want me to attend, I'll try to attend. I think the Discord link expired on your channel bio. Let me take a look at that. I apologize. I'm new to Discord. Sorry about that, guys. I'll try to figure out. I think somebody said I could create more of a permanent invitation link. And I'll try to figure that out. I couldn't figure it out last night, but I was on my phone watching a movie with my wife. Let me give it my full attention and try to figure that out. But keep those suggestions coming. Having a call on the Discord, awesome idea. Let's do it. And let me know how I could assist. Let's just keep it to stock investing. And if it helps the community, I'm all for it. Let's not talk about, classic cars or something like that, because then it'll take us off the tracks, so to speak. So, all right, good stuff. So we've gone over kind of like where the economy's at. Really looking at the weeks ahead, I think the VIX measuring as high as it did, this is what makes me think, okay, we're going to be in this thing for a month or two. And this is maybe we're halfway through this dip, and maybe we got another, on the S&P, another 5, 6, 7% of value to give. And then on the NASDAQ, maybe it goes down another 5, 10%. It's already down 10%. But this measure really caught my attention. I'm like, holy smokes, it exceeded last year. And last year, the S&P went down 10%. So if it popped up that high, what news can come next week that is going to make everybody feel better? There's nothing coming. All the big earnings reports from the big companies, they were this week. Next week, we have some interesting companies, but they're not massive market caps. They're going to move the market. So I think next week's going to be a down week. It'll be another week where buying good quality companies is a really good idea, and taking advantage of lower prices. So that's what I'm seeing out there. All right, so we've been going for about 52 minutes. Any other talking points that you guys want to go over? I'm going to go over Exxon just real quick. Exxon's an oil company, and they were flat. And on a day like this, that's pretty darn good, right? And over the last year, they are up 10%. They pay a nice dividend of 3%. So they announced their earnings, and I think their earnings were favorable. Their earnings topped, expectations, which looks good. Exxon is the biggest energy oil company, I think, on the market. There's a bigger company in Saudi Arabia. It's called Aramco, I believe. And I think you could buy into that one. That one's got a $1 trillion valuation. And that's basically the Saudi Arabian oil complex. But this is Exxon. This is headquartered in Houston. And this is a pretty solid investment, especially if you see oil prices go up. And then Chevron is a stock that I own. And on a day like this, 2.7% decline, that's not too bad. It was disappointing that they didn't execute as well as they should have. I think they had a problem with their margins, but they're a pretty solid company. I think I'm gonna be just fine. They haven't been rising a whole lot, and I think it's because oil prices haven't really rallied, which is kind of weird. There is tension in the Middle East, but oil prices have kind of stayed around, between $70 and $80. They were creeping up into the 90s, but if oil prices start to rise, oil companies become really, really valuable. They're already very valuable because they're an oligopoly, a bunch of companies that kind of run this particular industry. All right, guys. So I wanted to have the live stream. I'm glad we got together. Everybody hang in there with your stocks and just keep analyzing your companies. Be smart about your investments and don't let the bad news get to you. Look at it as an opportunity as opposed to, Oh no, this is like doom and gloom. Here's Mike, the dividend investor guy. I'm looking strongly now at IWM. This is good for a while, and I believe. Have you looked at USOI? So let's look at those real quick. So that was IWM. iShares Russell 2000. Okay, so this is to take advantage of small caps. Russell 2000 ETX. That might be a good play. I think it might be a good idea. I'm not a big ETF guy, but I'm beginning to. You guys are beginning to rub off on me, and I'm thinking maybe I should use a couple ETFs to my advantage. And then this is crude oil shares covered call. I'm not quite sure what this is. This is the UBS AG crude oil shares covered call. I'm not sure how this works, so I'd have to figure out how it works. But this one, I understand how it works. It's an ETF on the Russell 2000. As the Russell 2000 does better, so will this ETF. That makes sense. That might be a good idea. I like individual stocks, and even with bonds, I like individual bonds. And I feel that I can really fit my portfolio around exactly what I want to accomplish. And I really can go into the companies that I believe in. That's another reason why I like individual stocks, as opposed to leaving it to somebody else who make decisions on what's going to be in that ETF. But that's just my preference. And not too long ago, I was in ETFs and mutual funds, but I decided a ways back that, hey, I just want to be in stocks. I want to control my own destiny with regards to stocks. All right. So I think we're at a good point to stop. It's been a good live stream on Sunday. I'm going to join forces with Scott's due diligence. I really encourage you to tune in. I'll take a look at that link to the Discord on my channel bio. Make sure that I've got an active one. I'll try to figure out how to have a permanent one so that it doesn't time out anymore. And keep the ideas coming. I really appreciate it. Everybody have a nice weekend, and let's try to forget how much money we lost this week and try to take advantage of these lower prices. Take care, everybody.